Hello everyone, George DeSantis here. It's Thursday, October 13, 2022. I thought I would do a short video because I was looking at some charts and found something that I find very interesting and I want to share it with you. Okay? Before we get into that though, the usual, I have to bring up a disclaimer. So here it is. It simply informs you that I'm not a licensed professional investment advisor. So this is not an attempt to give any particular person investment advice. I am a psychologist. I do this for my own purposes. I share it with others. And in the last couple of years, I've been making a YouTube video sometimes and posting it, and anyone can look at it and do whatever they wish with it. But it's not an attempt to give investment advice. I'm just going to share what I'm seeing on the charts here with you. Okay, so let's begin by bringing up some charts here now. All right, so let's begin with a weekly chart of the S&P. All I have on this chart are the price bars represented by candlesticks and a 9 exponential moving average and a 30 front weighted moving average. See, front weighted moving average a 30, an exponential moving average a 9. So this is what I refer to as a 930 approach. Now, where do I learn this? Many years ago, I met over the internet someone by the name of Rick Monteith, and he had his own brokerage house where he did futures trading, and he also did some instructional stuff, videos, etc. So that's where I met him, and he had a free video and others instructing us about the 930 system, and he would show how he used it in live sessions, etc. So his claim was that the 930, as he called it, works in all time frames, in any time frame, with any tradable, as long as you have the usual type price bars, etc. Excuse me. So then I recently saw a guy on one of these webinars talk about, he's a medical doctor, but he does a lot of trading. And he talked about the market really respects that 30 moving, 30-week moving average. You see, I'm moving the cursor here now on the green line, which is the 30-week moving average. He says as long as price is above that, you have an uptrend. And when price is below it, you have a downtrend. Now, of course, it's not always very clean, like this area here. You're going to get some whipsaws where you dip below the moving average. But when you add the 9 EMA, you could see that as long as the 9 is above the 30, we had a nice, really long uptrend here from about March of April or so of 2020 all the way to the end of 2021, early 2022. Okay, and then we had a breakdown. The 9 crossed below the 30. So when the 9 crossed below the 30, this could be one of the signals to lighten up on your stocks. And if you're trading the index, of course, you sell the index. And if you know how to do it, or if you use options, etc., and you're free and you're capable of going short, either using leverage short ETFs or otherwise, you could go short here, and of course this is all hindsight, but you just go short here and you're riding this wave now. Now notice the 9 EMA never crossed the 30 weighted moving average. Even here, it never crossed above. Okay, so you had a solid uptrend and you're having a solid downtrend. So let's so let's go back and check a couple of other entries and exits and see what it looks like. Okay, so for example, let me move this back here. All right, so I think I drew some circles going all the way back to 2016. So 2016, we got a bullish signal here, 9 crossing above 30, right? Here we had a bit of a whipsaw, but pretty soon it recovered, 9 above 30, right? All the way here. And I haven't done any calculations in terms of if you traded it, how much money I would make. And again, it's all hindsight, but hindsight is pretty useful if you could learn from the history, from what you didn't do, from what you did, etc. I mean, that's how I learn anyway, from the mistakes I made or opportunities that I missed. Okay, so here we have 9 crossing below. So you might want to get out of the index here, and it crossed back up here, you get in. You get out here, you get back in here, and you ride it all the way up until here. This was 2020. This is pandemic time, okay? March of 2020, March, April of 2020, right? Let's see. Yeah, this is around March, April of 2020. So you get out here and you avoid this big drawdown here. Or if you wanted to go short, you short this here. But now you're back in bullish territory, right? Above 30, and you're buying again, and you're holding it all the way into January of 2022. And it wasn't until February 4 that the 9 crossed on the weekly chart, crossed below the 30. Now you got earlier signals, of course, on the daily chart. And remember, we could use it on any time frame, of course. But you get more whipsaws, ins and outs, right? On the daily chart. Let's take a look. Let's look at the daily chart and see what we got. All right. So here's a daily chart. If we went all the way back, if we went all the way back to yeah, if we went all the way back to the entry all the way back here, which was around March, April, right? So let's say we got in here, but you see, we would be getting whipsawed on the daily chart, a lot more buy and sell signals, right? A lot more buy and sell signals here on the daily chart. Okay, that's the difference. And even this year from January, you could see that you're getting whipsawed a lot more. You got, if you shorted it here, right, in January 12th, okay, you got out of the market, but you stayed in here. Now you crossed back up. If you wanted to benefit from this short rally here, you were getting in here and getting out here and getting out about here, right? And so on. You were short here and you were long here, but you see the whipsaw? There's another whipsaw for you. You see, you get in, but you gotta get out, right? So I'm saying, well, the daily chart is obviously a shorter term, so you're gonna get a lot more whipsaws. But even on the daily chart, after August, you see, if you got out here, right? If you were in somewhere in here, right? If you got in here, you got out here, you got out on this crossover here, you still made some money from this level here to this level here. That's a nice trade. And now we've been in a downtrend all the way down on the daily chart. All the way down since what? Since it crossed over back on August 26th, when this June to August rally was done. Okay, so I just want to share some of these things with you. I think it's very instructive. So, question then is, since I have mostly cash, I only have a couple of things that I hold. Okay, that's LNG, and I have one long position. I'm playing the seasonal trade. It might not work out. I have a very small position in the seasonal trade, October to the second week in December. I'm playing that, okay, with SL, SX SPXL. Okay, I bought that. Well, a small position just to trade a seasonal trade, but it's not a big position. I'm not risking a lot. Okay. Now we looked at the S&P, but what if we looked at the Nasdaq? Why not take a look at the Qs, right? Qs. Okay. So this is a daily. Let's go to the weekly, and that's something I learned from Alex Elder. Alex Elder, and there's a good reason why he emphasized this. George, do not look at a daily chart before you look at a weekly chart, because you don't want to go against the weekly trend. You don't want to bet against the weekly trend. Okay, that's the whole idea. So here's the Nasdaq. Let's take the same time period. Okay, we were looking at from the pandemic here. All right, from the pandemic here, we came all the way down. But then the 9 crossed over the 30 here, somewhere in May, right? In May. And so if you got in here, you bought the Qs here, you could ride it all the way up. 9 stays above the 30, all the way until it crossed over here, which was in January 21st on the weekly chart, okay? That week of the 21st, in other words, right? But look at what it's done since then. Very similar. 9 stays below, even when you get these brief rallies, stays below the 30. Even when you get this rally from June to August, the 9 really doesn't cross much above the 30 here. It just fails. The rally fails. So it works on the Qs. It seems to work well on any time frame. It seems to work well on the S&P. And if I were to lengthen the chart, you could see going all the way back here, you could get a good idea that it really works here too, from 2016 all the way to 2018, and then you got out here with this downtrend, right? You got back in here, you rode it all the way up to 2020 until the pandemic, etc. Now let's do something, because you've heard me use the 4 EMA. Let's put the 4 EMA on the chart. I'm going to pause it for a second to do that. So I've added the 4 EMA, exponential moving average 4, right? And that's the yellow line. And I tend to use that too, but it's a much earlier signal. It's an earlier signal, and it really opens you up to more whipsaws, where you have more trades in and out, that sort of thing. Take a look here. You got in earlier if you traded the 4 crossing over the 9, so you would have been in the week of on the week of May 5th, May 8th, sorry, May 8th, right? Instead of May, what is this one here? May of June 12th, okay? Instead of June 12th. But you will also get whipsawed as you went up here. You will get whipsawed here. It kept you in a trade for most of this rally all the way up here during 2020, 2021, okay, until the end of the year, and then it breaks down here, right? So yeah, I like to look at the 4 and the 9 and the 30. That's why I have those 3 plotted there. The 4 EMA, I learned to use this from Dr. John Ehlers on in his article in 2002, where he wrote, I think it was 2002, he wrote in Stocks and Commodities about the instantaneous trend line and the Kalman filter. Kalman filter was simply a 4 exponential moving average, and that's where I learned to use the 4 exponential moving average. Okay, so you could see it doesn't get you in and out too often, but it rides above the 9. It's not that much different. Okay, see it here, the yellow line. Okay, so if you got in here, you would have a few, questionable areas here where you wonder if you should get out. But basically, you're in that trade. But when you look at this whole picture, the 30 weighted moving average is the line of demarcation that we ought to pay attention to. It's the trend line we ought to pay attention to. Whether you're using the 4 crossing below the 30 or the 9 crossing below the 30, they're very close approximations. Okay? So I just wanted to share that with you. And before we leave this, let's look at the Qs. We'll see very similar pattern. Okay? On the Qs, same thing. You're getting a little sooner here than here, and you're riding it all the way up. There's a bit of a whipsaw here, bit of almost a whipsaw here. But eventually, the 9 and the 4 cross below the 30 at about the same time. So I didn't put the 4 on initially because I wanted to keep it to 9:30. Okay, but now you can see even if you add the 4, you can get some decent trades here. But looking at the 9, let's remove the 4. Okay, looking at the 9 and the 30, you can see it gives you clear signals getting in and getting out. Okay. All right, folks, that's it. I just wanted to share that with you. So the question is, if I'm out of the market, when do I get back in? So my one answer to that is a lot of answers, right? One answer to that would be when the 9 crosses above the 30 again, when this red line crosses above the green line and stays there for a week or two, and see, and you see some other indications that the market is turning around, would be the time to start thinking about getting back in the market in a big way, I mean, yes, trading around it is fine, as Larry McMillan himself says. It's a downtrend, it's a bear market, but you could trade around it. You could trade it short term around it, downtrend, if you know how to do it successfully. But when do I get back in full swing into the market? When the 9 is above the 30, and of course, price bars are above the 30 here. Okay, just like we had here. That's when you want to be in the market. 9 above 30, price bars above here, right? That's it. I hope that helps. Anyway, it looks as though today we got some news on the price index, consumer price index, and it wasn't good. There's still a lot of inflation. However, the market was down initially about 500 points on the Dow, and as I speak, it's down 108. So there's some hope. It's coming back a bit. But you want to get back in the market? Look at the 4, look at the 9 and the 30 moving averages, okay? And wait for the 9 to get above the 30. Might take weeks, might take months, but you don't want to risk a lot of money unless you have something to base it on. And I like this picture, right? I want to see this picture again or this picture here. If you go all the way back, you get in here and you ride it all the way until you get out here. You got again, you could see you're low, you're getting in low, you're getting out high here. Okay, and you could do that all the way along. You get in, if you go back here, right? You get in low here and you get out, it's all the way up here. You get out here, right? So I just wanted to share that with you. This is the Nasdaq. Okay. All right, folks. Have a good day. If you have any comments, you could always email me. Okay, gdos1@optonline.net. Thank you.